Right, good day. Hi, it's Bernard here from Discovery Invest. Basically want to demo a recurring investment growth model, recurring premium investment growth model. The reason for this is obviously we've seen a lot of market volatility of recent, and a lot of investors are getting scared around this volatility, and hopefully this recurring premium investment model can give you some comfort as to what is actually going on inside of your investment. So what we've done here is we've assumed a 1,000 Rand a month payment over 60 months. That's sort of on the x-axis here, monthly payments. You're going to see this thing start to morph and change as we start messing around with these values over here. But essentially, I just want to give you comfort that over 60 months, if you're putting away 1,000 Rand a month, you're going to end up with 60,000 Rand, assuming you just stuck it under the mattress. But we don't want to stick our money under the mattress. We want to put it into a investment fund or a unit trust. And what I've assumed, or I've done here, is I've basically created some constraints around fund performance in any year. And I've said, well, let's assume that the high is 100 and the low gets down to 80. So a 20% swing in the market, right? And in year two, we could say, well, let's say the high got up to 90 and the low was actually around 75. So we're going a bit more bearish, right? And then in year three, we had a phenomenal year. So the high went up to 110 and the low was at 100. Year four, another phenomenal year. We went up to 130. The low again, sort of, let's say 90. Okay. And then we had a shocker in year five, where now all of a sudden the high went down to 80 and the low was around 70. So basically what happened here was, you can see that every time this black line sort of dips below the blue line, right? That means we are actually buying more units, right, in the market, because the price of the units are less than the average price of the units that we are holding in our portfolio. And remember, that is a very crucial element to recurring premium investing. Every month that you buy, depending on the price at which you buy the units at, or the unit price of the unit trust that you're buying, every month that you buy at a different price, your average price moves. If the price is higher, your average price will move upwards. It will move higher. If the price is lower than average price, it'll actually pull your average price lower, closer towards current price. Remember that. That's very key. You always move closer towards current price. So let's see what happened. In the first year, a high of 100, a low of 80. That's a 20% peak to trough sort of drawdown. And you can see definitely, if we look at this histogram, the shaded red and green bars, we can basically see here that we have put more money into this investment on average than what the investment is actually worth in terms of in the market, right? The only time that we sort of came up for air was this little bar over here, okay, where the random variable in year two basically picked us up above the average, okay? So really what this is showing is sort of what is referred to as Rand cost averaging, right? You buy an average in the market and you hope for the market to run away from your average. So I would put it to you that anyone that was sort of investing in the market 4 years ago, they're looking at something possibly like this, where, they've had pretty decent gains on their investments. I mean, if you just want to see how high these gains go, I mean, this one goes all the way up to just under 40%. If you look here on the right-hand side, okay, just under 40% return on my capital invested. So there, I've got 51,000 Rand in the investment, but I'd only invested 37,000 Rand. So that's sort of how you read this, right? And then obviously we had a shocker in year five where, we've now invested more money in the investment than what the investment is actually worth. I mean, drawdowns here of 24%. So the amount of money is now worth 38,000, but geez, I put in 51,000. That's absolutely shocking. Now, unfortunately for an investor that's sitting in that situation, the best thing to do is just to keep paying. Keep paying whilst you're below the blue line, and you will keep bringing your average price closer to current price. Let's look at another situation where maybe the crash happens in year 2. So again, we're going to start on 100. We're going to make that 90. We're going to go down to, let's say the high is 70 and the lows are like 50. And then all of a sudden the market starts to pick up nicely. So we get back up to 110. And let's say we end here at 190 again. And you can see it's very painful for investors in the first year, but that's really where the returns are coming from. Okay, that's really where the returns are coming from, because I get to build up this wonderful stack of cash. I've invested 24,000 Rand. At that point in time, the value of my investment is 20,000. The markets haven't fallen by all too much, because I'm sort of deploying the money in over an average period, and we had fairly high unit prices initially, right? But then all of a sudden the market rallies, and when it rallies, it lifts our entire average up. So literally that 1 month's move is akin to a 47.5% growth in the total portfolio. In other words, now the money is now valued at 36,800, and I'd only put in 25,000. And you can see as you sort of keep paying, that amount sort of starts to dwindle again until, in year 4, we raise the highest price again up to 130, and you can see, wow, you start participating in good gains again. Really, the message here is, that the key to successful investing in a recurring premium investment is embrace volatility. You really want to be able to invest in risk assets at the best possible price in the market. And then you want the market to sort of run away with your sort of base average in tow. So just to illustrate that, let's assume now that this high now breaks the previous year's high of 130 and ends up at 160, and the low sort of is pegged at the previous year's high. Now all of a sudden you get this terrible 2-year performance here that you've been collecting literally, 24,000 Rand, 25,000 Rands worth of premium, and then the market runs and is able to lift up your entire average right up to a point here where you're just shy, let's say, of you're about 60% on premium invested. So your investment amount is worth 97,500 and you'd only invested 60,000. So clearly, these things do take time. It's not something that we can, gaze into a crystal ball and tell you that, yes, certainly in 5 years' time, things are going to be a lot better than they are today. We can't do that. All we can appeal to you is to be very disciplined investors, be very steadfast in your resolve to stick to a long-term investment plan. Do not get shaken out by short-term volatility. I mean, let's just imagine quickly that the markets, stayed around 60 and 50, right, in year 3. That makes it even better for us, right, in year 4 and 5, because I've now had an extra year of really poor returns, okay, to be able to accumulate an average below the line, bringing my average price lower to current price, building an asset of scale at the best price in the market, and then waiting for the market to rip away and rally away from my average, taking a return that's now again 60%, strangely enough, right? But at certain points over 100%, at certain points. So this is a random things. I mean, if I just hit 130 there again, it could change it, and it does. So it all depends on what's happening in the market and the volatility of the assets that you are invested in. But really what this does show you is that even on a random framework of a random range of ranges that are quite large, you should be able to, as long as you accrue an asset of value at a really good price and be patient enough for that market to run away from that price and appreciate off that base, certainly there is massive opportunity for you to lock in really good returns relative to the amount of money that you've actually invested in these assets. So hopefully this gave you a little bit of intuition around how these things work. I'm sorry it was a bit long and unscripted, but I will appreciate your comments and questions. And thank you very much for taking the time. Bye-bye.